With what we're going to learn in this video, I think we can get a pretty good idea of what gold stocks are going to be the best performers or have the best chance to be a high performer in 2025. Over the past year or so, we've seen the stock price of some gold producers shoot straight up, while the stock price of other gold producers hasn't performed very well. So why is that? I'll tell you what I found, it's all in the financials. It's all in the financials. In this video, I'm going to show you what I mean. The first company I want to show you today is the biggest gold producer, Newmont. So over the past year, the stock price is up about 39%. So with that, let's go look at the financials to see why. So we're going to see the financials here, looking at the income statement by quarter with the most recent quarter on the left here. Keep in mind, I'm recording this in February of 2025, right before earnings season. So companies are just starting to report. The vast majority of gold producers have not yet reported Q4 earnings. I want to look at what has happened over the past year or so. So on most of the companies, I'm going to look at comparing quarter ending December 2023 to September 2024. However, looking at this quarter here, something happened where their numbers were way worse than normal. So you can see there was a huge drop here. So I don't think that this is a very good baseline for this company. So I would like to use September 2023 as the baseline here. Gross profit was $956 million in that quarter. Today, it's at about $2.2 billion. So it's more than doubled. But let's go down to EBITDA. EBITDA has gone from $817 million up to about $2 billion in the quarter ending September 2024. So EBITDA has more than doubled. So that's really good. That's a really good improvement. However, let's look at what has happened to the balance sheet during that time and what has happened to the share count during that time. So cash and equivalents from this quarter to this quarter is basically flat. It's down slightly. So that shouldn't really affect the share price. Let's look at liabilities. Current liabilities are way up. So these are liabilities that are due within the next 12 months, up from $2.8 billion to $6.4 billion. A long-term debt is also up from about $5.6 billion to about $8.6 billion. I believe this was because of a big acquisition that happened right here, right about here. So they added debt, and I believe they added shares as well. So we're going to go look at their share count here. So the acquisition happened right here. Share count went up from about 800 million to about 1.15 billion shares. So the share count went up substantially there. So even though EBITDA is up over 100%, the debt is way up and the share count is up quite a bit. So if EBITDA had doubled over the course of about a year, I would expect the stock price to approximately double if the debt stayed flat and the share count stayed flat, but it didn't. The debt went way up and the share count went way up. So we have to adjust our stock price downwards from that double, which I think is why Newmont sits at about 39%. So I know this is a lot of numbers and it can be confusing, but I think after looking at a number of examples, you're going to start to see a pattern here. Next, let's look at Lundin Gold. So this is a single asset producer. They have one producing mine in Ecuador. It's a low-cost mine, but it's a risky jurisdiction, and it's also risky that they only have one operating mine. This is one of the best performers in the gold producing industry. Stock price up 137%. So let's see why. For this company, I'm going to be comparing end of December 2023 to September 2024. Operating income has approximately tripled from 65 million to 188 million. Let's scroll down here. Interest expense has gone from 8.3 million in a quarter down to 0. So they've paid off their debt. Net income has increased from 11 million to 136 million. So way up. That's up more than tenfold. Let's go to EBITDA here. Like Newmont, EBITDA has more than doubled. It's gone from 96 million to 222 million. So considering that EBITDA has more than doubled, I would expect the stock price to more than double as well if the share count has stayed flat, if debt has stayed flat, and if cash on hand and cash equivalents has stayed flat. So let's go look. So balance sheet, cash and cash equivalents are down slightly. Let's look at debt. Long-term debt down from 242 million to zero. They have no long-term debt. So even though the cash is down slightly, the decrease of the debt is much more significant than that. How about shares outstanding? Shares outstanding basically hasn't changed. It's gone up slightly from 238 million shares to 240 million shares. So that's why the share price has more than doubled, because shares outstanding stayed pretty much flat, EBITDA more than doubled, debt went down, cash went down a little bit. So it makes sense that Lundin Gold has more than doubled. That's despite operating a single asset in a risky jurisdiction. Now I want to look at another top performer, Agnico Eagle Mines, up 112% over the past year. So let's look at their financials here. This quarter, December 2023, the one I would like to use, was a bit of an outlier. So earnings from continuing operations was way negative. Operating income was much lower than previously. So I don't think that's a very good baseline quarter to use. So I would like to use September 2023 as the baseline quarter. Revenue is up a modest amount from that quarter. Gross profit is up about, 500 million. Not bad, but it's not double either. Operating income has more than doubled, actually almost tripled since that quarter. So that's good. Let's go down here to EBITDA. What has EBITDA done? EBITDA has gone from 736 million. Well, actually, this is a decent, this quarter that I wanted to use is a decent baseline for EBITDA. So there's something that affects some of those other numbers, but that doesn't affect EBITDA. So yes, I think we can compare EBITDA from this quarter to this quarter because it's not an outlier here. It's right where it should be. EBITDA is up, let's say, approximately 50%. So all else equal, if the share count is flat, if cash is flat, and debt is flat, I would expect Agnico Eagle stock price to be up approximately 50% based on EBITDA being up about 50%. But even though EBITDA is only up 50%, earnings from continuing operations has approximately tripled. Operating income has almost tripled. Cash and cash equivalents. Cash is way up. Cash is up from 350 million to almost $1 billion. So when cash goes up, the stock price goes up. Let's check out debt. Current liabilities were about 1 billion, but we add what the long-term debt was, and we're looking at about $2.8 billion here between these two numbers combined. Over here, we're looking at about 2.7 billion. So that's relatively flat. How about shares outstanding? Let's look at the shares outstanding. Up slightly. So based on all that information, over the past year, Agnico Eagle is up more than I would expect it to be. Next, let's look at an underperformer to see why it's underperforming. This is Eldorado Gold, up 23% over the past year. So let's click over to their income statement here. Again, the most recent data is September 2024. Revenues are only up slightly. Despite the gold price increasing a lot during that time, revenues haven't gone up much. Same goes for gross profit. Hasn't gone up much. 165 then, 187 now. Operating income up a decent amount, up about 35%. Okay. Earnings from continuing operations only up about 10%. How about EBITDA? What has EBITDA done? EBITDA has gone from 141 to 167. Right in line with how the stock price has performed. The stock price has only gone up a little bit. Well, EBITDA has only gone up a little bit. But let's go take a look at the balance sheet here. What has cash done? Cash is up. That's good. How about debt? I want to look at current liabilities. Current liabilities are up from 274 to 350. Long-term debt is also up about $200 million. So if you combine these two numbers here, long-term debt and current liabilities, they were about 900 million. And now it's about 1.2 billion. So that's going to hurt the stock price, all else equal. How about shares outstanding? And shares outstanding are basically flat, up 2 million shares, which is pretty typical because part of the executive's payment The part of their salary is stock options. So when you issue those stock options, the share count goes up a little bit like you see here. With all of that said, it's not a surprise that Eldorado is underperforming many of the other gold producers because their EBITDA hasn't gone up very much. Their revenues haven't increased much. Their gross profit hasn't increased much. Earnings from continuing operations hasn't increased much. Yeah, makes total sense that this stock is up 23%. Next, I would like to look at one of the sector's biggest underperformers in terms of the mid-tier gold producers or major gold producers, and that is B2 Gold. Over the past year, it's down 4%. So why is that? Let's go look at the financials here. So clicking over here to the income statement. Despite the gold price going way up, revenues have actually gone down, 512 million to 450 million or so. Gross profit is down. Operating income is down. And how about EBITDA? EBITDA went from 278 million to 194 million. EBITDA is down. The stock price is down. Now, there is risk here in terms of the countries that they produce in because their biggest mine is in Mali, and there's been a lot of problems in Mali recently. So yes, that has caused the stock price to be depressed, but I think perhaps even a bigger issue is the fact that they made less money. You make less money, your stock price goes down. How about cash? So cash is up over this time frame, but I follow this company very closely, so I know the reasons for that. The reasons for that is because they took on some debt and they took on a gold prepay. So they got $500 million from a gold prepay and they took on $200 million of debt. So that's why their cash is up. And also, during this time, they're spending a lot of money building their new Goose mine. So that's a big drain on cash during this time. Let's look at current liabilities and long-term debt. So current liabilities have gone up from 313 million to 500 million or so. Long-term debt is up a little bit, but that's kind of a lie. So these current liabilities, they have a gold prepay coming due soon. So this current liability should be a lot bigger than this, or would be a lot bigger than that today. And their long-term debt. Here they had debt, but in the following quarter, in the beginning of the following quarter, they took on that gold prepay and they paid off that debt. But then they took on some more debt a few quarters later. Total liabilities here, we can see that it has gone up from 960 million to 1.6 billion. It's gone up over $600 million. How about shares outstanding? Shares outstanding are basically flat, just enough to pay executive compensation. With that, it should be no surprise that the stock price is down. In fact, maybe you would expect it to be down more, considering how bad these numbers look. Revenues are down, gross profit is way down, as I was saying before, operating income is down, EBITDA is down quite a bit. But you can't just say, oh, well, that's because the company sucks. No, that's a loser company, you have to avoid it. No, you have to look at the reasons why. The reasons why is because they're having some trouble in Mali. Their Mali mine is going through a period of lower grades, higher costs. They're also spending a bunch of money in Mali on a big solar plant, and they're also spending a bunch of money in Mali developing a new tailings storage facility. That's bringing costs up. Also, a drain on their cash is them building their big new Goose mine in Canada. It's going to be, or it's hopefully going to be, a very low-cost mine that's going to be producing over 300,000 ounces of gold a year. That's going to be doing very good things for all these numbers after that's in production. But meanwhile, while it's still being built, it's a big drain on the company's financials. With a company like B2 Gold, you can't just look at these 2024 numbers and say, oh, this is a terrible company. Yeah, 2024 was not good. 2024 kind of sucked for B2 Gold. But with a company like this, you have to look forward. And looking forward, is it going to be a good buy or not? And now let's look at another company that has underperformed over the past year. Now, you might think, okay, up 32%, that's not bad at all. Well, it's not, but we got some really good news right here. And that sent the stock shooting higher over the past few weeks. But up until here, the stock was barely up at all over the past year. So it's really up. Most of this 32% gain is because of this great news we got right here, plus the gold price increasing over those few weeks as well. So with that, let's go look at the financials. So going to the income statement here, revenues are up a decent amount, 120 million. Gross profit is up about 50 million. Okay, that's good. Operating income is up a lot from this quarter, but this quarter was an anomaly because that was way down from the previous quarters. How about let's scroll down to EBITDA. What has EBITDA done? EBITDA has gone down a little bit. EBITDA was 266, now it's 245. So with that, all else equal, you might expect the stock price to be down a little bit. But Endeavour, like B2Gold, they were going through a big CapEx phase in 2024. They had a big expansion project and they were building a brand new mine. So that was a lot of expenses that were draining their cash and weren't contributing anything to revenue. So here you see cash is down quite a bit. What has debt done over that time? Current liabilities up a few hundred million there. Long-term debt basically flat. Total liabilities more or less flat, but up a little bit over that time frame. Okay, how about the share count? What has the share count done? The share count is basically flat, down slightly. But I do know that they bought back a bunch of shares in Q4 and in Q1 of 2025. So this share count has fallen even further than this. And again, it's February 2025, but we have not gotten Q4 2024 numbers yet. Now let's look at another great performer in 2024 or over the past year, and that is Alamos Gold, up 90%, almost 100%. So let's go take a look at the income statement here. Again, the most recent data is September 2024. Revenues are up quite a lot. Revenues are actually up nearly 50%. Gross profit has almost doubled. So that's very good. That's way more than many of the other companies. Operating income is up substantially, not quite double. Earnings from continuing operations, nearly double. How about EBITDA? EBITDA has gone up from 122 million to 190 million. Not quite a double, but up substantially. That's good. Okay, let's see what cash and debt and share count have done during that time frame. Okay, cash is up 238 million to now 316 million. How about debt? They took on some debt, but that's actually not them taking on debt. That's because they did an acquisition here, and the company they acquired had some debt. But I'm guessing that debt is going to be paid off very soon. So total liabilities have gone up during that time frame, about $700 million, and current liabilities have increased a little over $100 million. So here, looking at the debt, you might think that was bad news over that time frame, but this acquisition of Argonaut Gold was widely regarded by investors as a very good acquisition. So this is a case where, hey, like, this doesn't look good based on the numbers, but if you know why these numbers changed, you would know that it was for very good reasons. And then how about share count during that time? Well, share count went up a bit because of that Argonaut acquisition. Based on the numbers we're seeing from their income statement, with all these numbers being up substantially, it's no surprise that the share price has nearly doubled during the past year. And these numbers are probably going to improve further when we get Q4 2024 information. And now let's look at another big winner over the past year, and that is Pan American Silver, up about 92%. And all these are gold companies. And yes, it says silver in the name, but really Pan American is a gold producer. The vast majority of the revenue comes from gold. So let's look at their financials here. Their income statement, most recent information, September 2024. Gross profit up substantially, almost double. Their stock price has almost doubled. Okay. Operating income was negative. Now it's a positive $149 million. Okay, that's good. Earnings from continuing operations was negative. Now it has gone less negative, and now into the positive. That's really good as well. Okay, how about EBITDA? EBITDA has gone from 137 million to 288 million. So EBITDA has more than doubled, but did they make an acquisition during that time frame to cause that double to happen, or to help that double to happen? Let's see. Let's see if the shares outstanding has changed. No. I knew Pan American had made an acquisition sometime in the recent past, but that happened back here, looks like end of 2022, beginning of 2023, where their share count went up a lot. But from here to now, their share count is actually down slightly. Okay, let's go look at their cash on hand and their debt. See how those have changed. So cash and cash equivalents up slightly over that time frame. How about debt? What has happened with their debt? Current liabilities have gone up a little bit. Long-term debt is basically flat. How about total liabilities? Basically flat. Okay, so their EBITDA has more than doubled, with the share count staying basically flat, debt staying basically flat, and cash staying basically flat. So it's no surprise, once again, that the stock price has about doubled over the past year. And there seems to be this perception, at least in my comments section, that only stocks that are in good jurisdictions with low-cost mines are the stocks that are going up a lot. But Pan American Silver has relatively high-cost mines in relatively risky jurisdictions like Mexico and Peru, maybe I think Bolivia too. So despite operating relatively risky jurisdictions and having relatively high-cost mines, it was still a very strong performer over the past year. Why? Because their financials improved a lot over that time frame. When I was doing research for this, I looked at a lot more companies like this. I looked at about 30 different companies. And in almost every single case, the stock price over the last year followed what EBITDA did. And also, in most cases, it did not matter whether the company had high-cost mines or low-cost mines. What mattered is, were they making more money now than they were before? And also, in most cases, jurisdiction did not matter much. Lundin Gold was way up, one of the biggest winners over the past year, despite operating in a risky jurisdiction. Pan American Silver, way up, huge winner despite having high-cost mines and operating in risky jurisdictions like Peru and Mexico. Jurisdiction did matter in cases where the company has all or most of their operations in Canada. Canada right now is perceived as a very good jurisdiction. Agnico Eagle, even though their EBITDA went up less than 50%, the stock price was up over 100% during that time frame. New Gold was another example of this, where the stock price went up a lot more than what you would expect based on the increase in EBITDA. And also keep in mind, it was EBITDA adjusted for share count, so EBITDA per share, or operating income per share, or gross profit per share. But the cases where jurisdiction did negatively affect share price was those with exposure to Mali, for example, like B2 Gold. B2 Gold has a lot of exposure to Mali, and right now investor perception of what's happening in Mali is highly negative. So basically any company with exposure to Mali is getting punished for that. When I'm personally deciding on which companies to buy going forward, I'm thinking about these things. Which companies are going to be improving their EBITDA going forward in the coming quarters, in 2025, and even in 2026 and perhaps beyond. And this is what I'm positioning my newsletter subscribers for. I have this newsletter where I tell you what I'm buying or selling with my own money. And I'm looking at what I think are going to be the best risk-adjusted returns. So hopefully I'll see you over there.